Okay, so after we have prepared the financial statements, right, and the financial statements were prepared using the adjusted trial balance amounts. After we've prepared the financial statements, that was our goal of our accounting cycle, was to be able to communicate about how our business did. So now we're just going to get ready for the next accounting period, and that's what the closing entries are needed to do. Now, if you think back to when we learned the accounting equation, we said there were three things that changed retained earnings: revenue, expenses, and dividends. Okay. Now we're going to see how that happens. That happens during the closing entries. These accounts are going to update the retained earnings account. Okay. And so we want to close these accounts. We want to set them back to zero. We want to start the new period with zero in revenue, zero in expenses, zero in dividends. And if you think about it, when we want to know the net income of a company, we want to know what it is for the last period. We don't want to know what's our net income since we started the company 25 years ago. We want to know how did we do in the last period. Okay. So we want to set these accounts to zero. And so this is how it happens. I'm going to show you in T accounts. We know the formal process is to make journal entries, but I like showing it into T accounts because then you can see how the balance becomes zero. So let's say one of these accounts, so this would be an expense account, so because it's got a debit balance of $870. If we want this expense account to have a zero balance, we need to put an $870 on the credit side of that T, and then that will make the account have a zero balance. So that's what we're going to do in these closing entries. That's how we're going to get revenue, expenses, and dividends to have a zero balance. We're going to put their balance on the opposite side of the T. That'll zero out the account. And we know we can't just put a debit or a credit in an account and call it a day. We know if there's a debit, there also has to be a credit. So we're going to use an account called income summary to be the other half of our closing entry. So we only use the income summary account for closing. In fact, we're just going to use it to close our revenue and expenses, and then we don't need income summary again till the next accounting period. So then we're going to close income summary. So we're going to only use income summary in 3 journal entries, and then it's going to be gone until we do closing again. You're going to see income summary will not have a balance when you're doing your financial statement, so you will never see income summary on a financial statement. So we got 4 steps in our closing process. First, we close revenue, then we close expenses, then we close income summary, and then the 4th thing we do is we close dividends. So let's take a look at these steps. First one, we need to close the revenue account. So here we've got service revenue. It's got a credit balance of $23,320. We want it to have a zero balance. So that means we need to put $23,320 on the debit side of service revenue. Because when we put $23,320 on the debit side of service revenue, that's going to cause it to have a zero balance. We can't have a debit without a credit, so we put the credit into income summary. So after this first closing entry, service revenue has a zero balance. Income summary has a balance equal to the amount of revenue. That's step 1. Step 2, we need to close all of the expense accounts. We want all of the expense accounts to have a zero balance. So you need to close every individual expense account, right? Utilities expense has a $225 debit balance. We need to put $225 on the credit side. We need to put $625 on the credit side of insurance expense. $512 on the credit side of depreciation expense, right? So that will cause all of these to have a zero balance. And the total of all of your expenses then, right? We can't just put credits in accounts. We need to put a debit somewhere. The total of all of the credits you've put into the expense accounts is going to be debited to income summary. So here's all the rest of our expenses. Every single expense needs to be credited individually. Okay. So the total of all of our expenses comes to $6,739. The total of all the amounts we put on the credit side of the T's comes to $6,739. So we need to put $6,739 on the debit side of income summary. So after we've made this second closing entry, right? Revenue has a zero balance. All of your expenses have a zero balance. And income summary, right? We've got the balance of revenue on the credit side of the T. We have the balance of expenses on the debit side of the T. To find the balance of a T account, we subtract. So we're going to be subtracting revenue minus expenses, and that'll give us the balance in income summary. And what do we call revenue minus expenses? Right, that's our net income amount, right? So if we subtract 23,320 minus 67,39, that gives us 16,581. Income summary would have a credit balance of 16,581. So since it has a credit balance of 16,581, to close it, we're going to put 16,581 on the debit side of income summary. Can't have a debit without a credit. Our credit goes into retained earnings. So this is our closing entry. Debit income summary for $16,581, the amount of net income. Credit retained earnings for $16,581, the amount of net income. Right? And if we add together, the debit side of the T has a balance of $23,320. The credit side has a total of $23,320. We subtract the debit minus the credit. Now income summary has a zero balance. And let's think about it. What happens to retained earnings when we credit it? Does retained earnings go up or down because of a credit? Right? So what's the normal balance of retained earnings? It's not in the word dead, where our debit balance are expenses, assets, and dividends. So retained earnings has a credit balance. So if we credit retained earnings, we're making it go up. And so in this closing entry, we're making retained earnings go up by the amount of net income. If you think about our retained earnings statement, right? Our retained earnings statement, we take the beginning balance, we add net income. So this is where retained earnings goes up by net income when we do this third closing entry. All right, so now after step 3, revenue, expenses, income summary, all have a zero balance. Retained earnings has gone up by the amount of net income. Now we need our last closing entry. We need to close dividends. Dividends, right? That's in the word dead. Our debit balance, our expenses, assets, and dividends. So dividends has a debit balance of $3,500. We want it to have a zero balance, so in our closing entry, we're going to put $3,500 on the credit side of dividends. Can't have a credit without a debit. Our debit goes to retained earnings. So now dividends will have a zero balance. And if we debit retained earnings, we said retained earnings has a normal balance of credit. So if we debit it, we're making it go down. And that's what we say on the retained earnings happens because of dividends, right? We subtract dividends on our retained earnings statement. This is where it happens in our system, right? So now, after we've done our fourth closing entry, revenue, expenses, dividends, and income summary all have a zero balance. Retained earnings has gone up by the amount of net income and down by the amount of dividends. That's what we accomplish in our closing entries. Now I showed you in the T accounts because I like how that shows you how we get to the zero balance, but we know the formal accounting process is doing journal entries. So here it is in journal entry form. Debit service revenue, credit income summary. Our second closing entry, we debit income summary for the total of our expenses. We have to credit every individual expense for its balance because we then have to post to the ledger and we want to show every expense account in the ledger with a zero balance. You can't just say expenses $67.39 and call it a day, because you don't have any place to post $67.39. You don't have an account just called expenses. You have all of these individual expenses in our general ledger, and this is where we have to move all of the accounts. Then our third closing entry, debit income summary, credit retained earnings for the amount of the net income. Our last closing entry, we debit retained earnings, credit dividends to close out the dividends. So only one deviation we could have from this process, and that would be if we had a net loss instead of net income. So let's say for this company, revenue was $2,400, expenses were $3,000. That means they had a $600 net loss, right? Because expenses were higher than revenue. So if that's the case, income summary is going to have a debit balance of $600. So when we want to close income summary, we need to credit it for $600. Our debit will be to retained earnings. Retained earnings has a normal balance of credit, so if we debit retained earnings, we're making it go down, and a net loss will make retained earnings go down. So if that's the case, this would be our journal entry. Debit retained earnings for the amount of the net loss, credit income summary for the amount of the net loss. Okay, so after we have made all of the closing entries, we would post to the general ledger. After we do posting, we have to do a trial balance. So this is our last trial balance. And so on our trial balance, right, it's the after closing, the post-closing trial balance. Think about it. We didn't use any of the assets in the closing entries. So all of the balances for the assets are going to be the same as what they were shown on the adjusted trial balance. Your liabilities weren't used in the closing entries either. So these are going to be the same balances that you showed on your adjusted trial balance. Capital stock or common stock, we didn't use that in our closing entries. So this is going to be the same amount that you showed on your adjusted trial balance. Retained earnings, this will not be the amount from your adjusted trial balance because this amount did change during closing. The amount shown for retained earnings on your adjusted trial balance is your beginning retained earnings. So when you're doing your statement of retained earnings, your beginning balance, you pull from your adjusted trial balance. You add your net income, you subtract your dividends, and that ending retained earnings number is going to be the amount that you show on your post-closing trial balance. On our adjusted trial balance after retained earnings, we'd show dividends, and then revenue, then expenses. All those accounts now have a zero balance, so we don't need to list them. If it has a zero balance, you don't need to list them. So that's why retained earnings will be the last account on your post-closing trial balance. And again, we want to total the debit column, total the credit column, make sure that debits equal credits after you've posted your closing entries.